A good day to you all. Welcome to the Chartered Accountants Academy, Management Accounting and Finance. The presenter for the day is Mutsawashe Mbaiwa, who is a lecturer in the Management Accounting and Finance Department. And today I'm going to be covering with you performance evaluation. So our learning objectives are to understand why performance measurement is important. Number 2, to distinguish between functional and divisionalized organizational structures and the concept of control. And last but not least, to discuss how residual income and return on investment and how they tie into net present value. Now let's get right into it. Now, why do we need performance management? First of all, to encourage goal congruence by evaluating managers on measures which will maximize sustainable long-term growth. Now, due to the sizes of entities, they are often divided into separate independent divisions, but many may act in the best interests of the division and not of the company. So therefore, it is needed that performance measures ensure goal congruence. Now, for example, if bonuses depend on short-term profits, managers will do anything to increase these profits. So this might not be in the best interest of an entity who wants to invest in long-term sustainable growth. So for example, a manager can invest in a project with a net present value if it will increase the current year profit in the short term. So that's a classical example of how a manager might not act in the best interest of the entity. So the best way to fix this is to evaluate on a longer term. So to encourage goal congruence, there is need to evaluate managers on measures which will maximize long-term growth. And also, there is need to align the employees' goals with the entity's goals so that all goals come together to encourage goal congruence. Now, our second issue, or our second reason why we need performance management is to prevent the urgency problem. Now, in general, what is an urgency problem? So this is a problem that occurs or usually happens when an agent of the company, that is usually management, does not work in the best interests of the shareholders. So your shareholders can be your stockholders, can be your investors. So because management is hired as an agent for the shareholders, it is supposed to make decisions that will benefit shareholders, which in most cases is to maximize shareholders' wealth. Now, when a manager, however, decides to work in his own best interest, instead, an agent's problem now occurs. So the agent might ignore what is best for the shareholder and do what is best for him instead. So managers might want to maximize their own wealth, but this might cause a conflict between the managers and the shareholders. So to minimize this agency problem or this conflict of interest, to encourage managers to work in the best interest of shareholders, an entity or the shareholders might introduce incentives. So incentives can be in the form of money or can be in the form of direct influence in the decision-making process, so that the agent himself or management are involved in the process of decision-making, which makes them be in a better position to work in the best interests of the shareholders. Management can also be issued threats of being fired if they don't provide measures that are in line with promoting the best interests of the shareholders. So these are the major reasons why we need to perform performance measurement. Now let's move on to our next concept. So we're first of all going to discuss the concept of control. So control depends on a company's structure. So when you're evaluating control, we always need to understand the structure of a company to understand what is it that they control. So is it a cost center? Is it a profit center? Or is it an investment center? In terms of structure, is it a functional structure or a divisionalized structure? So the functional or divisionalized structure works hand in hand or attributes to what a manager what a manager controls. So why is control important? Control is important because a manager or employees are supposed to be evaluated only on items within their control. So for example, when evaluating a manager, we need to exclude allocated head office costs, taxes, central administration costs, financing costs, for example, unless if the manager is responsible for financing decisions. So the underlying concept is a manager or an employee should be evaluated on items within their control. Now linking it, as I highlighted earlier, control depends on the structure. Now let's expand on the types of structures that an entity might have. So for a functional structure, a manager is responsible for your function only. There is little independence as you can only control your area. Hence, you are only evaluated on your area. So as an example, if I'm a marketing manager, or if I'm a marketing manager as an example, I'm only evaluated for my function, that is the marketing function. So if marketing is something to do with sales, is something to do with promotions, I'm only evaluated for items under my control. So if I control the marketing campaigns, if I control the marketing budget, I'm evaluated for those specific items that are under my control. Whereas a divisionalized structure, there is a decentralized decision making. So if I'm a manager under a divisionalized structure, I can control investments and profits as well as costs, which leads to a decentralized decision making. So the advantage is using a divisionalized structure, it improves speed and quality of decisions. Why? Because decisions are made by the people who know the product best. And the major disadvantage goes back again to the urgency problem, where managers might act in the best interest of the division and not for the entire company. So in evaluating is a highlighted control. So when I'm evaluating a division, a strong manager who runs a poor division, or as it turns out, runs a poor division, it is not fair to evaluate the manager based on the division, but rather on what they control. So if they control, for example, the type of employees that are resulting in a poor division, I can evaluate them based on the division. And also another dilemma can be, if I have a strong division, in spite of a weak manager, how can I evaluate this division? So it always depends on the control. That's the most underlying concept. So if the manager controls the employees, controls the processes, controls the operations, we can evaluate the division, when we are now, the division's performance will have a direct effect on the manager's performance. So that's a wrap up on control. Now let's move on to the performance measures. So as I highlighted earlier, we're going to be talking about, specifically going to cover residual income and return on investment and how they fit into net present value. Now, in measuring our performance, we have financial and non-financial measures. So I'm going to touch on the return on investment and the residual income, which are financial measures. So the return on investment, the formula is profit, which is usually after interest but before tax, divided by the investment, which is usually total assets. As a financial performance measure again, the return on investment can be further explained using the DuPont model. So by the DuPont model, I need my profit margin, which is my profit divided by sales, which measures the efficiency of revenue and expenses, divided by my asset turnover, which is sales divided by investment, which measures the efficiency of the use of assets to generate revenue, that is capacity utilization. So I can use the DuPont model to further explain the return on investment. As you look back at the formula for return on investment, there's a link between profit margin and asset turnover. Also, as a performance measure, we have what is known as residual income, which is my controllable contribution less my weighted average cost of capital multiplied by controllable investment. As I highlighted earlier, everything is hinged on control. So I'm evaluated on my controllable contribution less my work multiplied by my controllable investment. Also, as a performance measure, we have what is known as economic value added, which is obtained by economic profit less my work multiplied by total assets less current liabilities. So the economic value added is a modified residual income. Last but not least, as part of our performance measures, we have non-financial measures and use of common ratios. So in relation to common ratios, I would advise you to go back to your previous studies where we covered ratio analysis. That can help you to recall knowledge that you need to apply when we're using common ratios. Now, let's start off by using return on investment. So return on investment is a revision. Why do we say so? We covered return on investment when we covered capital budgeting. So return on investment is often called the accounting rate of return as it is based on accounting numbers. So when we're using return on investment, we should always consider return on investment relative to both division return on investment and group return on investment to ensure correct decisions are made. So as an example, if I have a project with a return on investment of 20%, a divisional return on investment of 25%, and a group return on investment of 15%. The division, to promote goal congruence from a group's perspective, should not accept the project, although it is a higher return on investment as per the divisional return on investment. The project's return on investment is actually lower than the group's return on investment. So from a group's perspective, the project should not be accepted. Another concept on return on investment is which assets are included under investments. So when we discuss assets, when we discuss investment, we talk about assets. Now, which assets should we use? So for assets that you could use your total assets. You could use your total assets less your current liabilities. You could use your assets at carrying amount or at market value or at original cost, or you could use opening balances or closing balances. So these are some of the decisions that you need to make. Now, under investments, which investment should I use? To help you further, let's discuss what we mean when we say total assets. So total assets can be total assets available, which is all your assets regardless of their particular purpose, or can be total assets employed. Now this includes total assets available minus the sum of idle assets and assets purchased for future expansion. For total assets less current liabilities, we mean these exclude the portion of total assets employed that have been financed by short-term creditors. So now the choice to you, or when deciding which assets to use under investments, number one, will always depend on the information that you've been given in the scenario. Are you able to come up with your total assets employed, or are you able to come up with your total assets less current liabilities, or you've only been given the total assets? So it depends on the information that you have been given. And number two, it also depends on how reasonable it is to use total assets versus total assets employed. So it's a choice, or it's a decision that you need to make. So to also help you in deciding to overcome this problem, we need to base our performance measures on original cost or replacement cost. To help you in making the decision, we need to base our performance measures on original cost or replacement cost. And also to help you, why would you want to choose your total assets less your current liabilities? So to further explain, we're now saying current liabilities are an interest-free source of finance. So we need to look at what assets need to be financed. So we can delay payment and use spare cash for business instead of getting more funding. So we need to look at assets that need to be financed. So a company should be rewarded for using its creditors wisely, as they do not need to raise additional funding. So the concept links back to working capital management. So for example, we can take 3 months to pay our creditors and debtors pay within 1 month. So we have extra cash for 2 months that doesn't need to be financed. That's the reason why we exclude our current liabilities. So that's a wrap on return on investment. Now let's discuss advantages and disadvantages of return on investment and residual income. So to help us in this discussion, we're going to be evaluating the characteristics of each performance measurement method and identify advantages and disadvantages. Now, as the formula for return on investment, that's your profit divided by investment. The advantage is it is simple to calculate, and it results in a percentage, which is a relative measure, and it is easy to compare. So I can be able to calculate, as in the example I gave you earlier, I'm able to compare the group return on investment, the divisions, and the project, because they are a relative measure. So I'm able to make a decision based on the relative measure, which is a percentage. Now, the biggest disadvantage of return on investment is it ignores risk. Number two, it is easy to manipulate. So if I want to obtain a higher return on investment, I need to manage my investment. And how do I manage my investment? Instead of purchasing more assets when there is need, I might delay to purchase those assets, resulting in me having a lower denominator, which is my net assets value will be lower than expected, with a higher profit will result in a high return on investment. So it is easy to manipulate, especially if it is hinged on a decision. So in line with that, an entity can make an incorrect decision. If a manager manipulates the return on investment, the entity as a whole might end up making an incorrect decision. And as it is an accounting-based measure of profit, this supports how it is easy to manipulate. Now let's move on to residual income. For residual income, the formula is our controllable contribution less my weighted average cost of capital multiplied by controllable investment. So the advantage is it considers risk, that is through the weighted average cost of capital. It usually motivates the correct decisions. Why? Because it is based on controllable, what the manager or what the division can control. And it considers income earned relative to investment made. So income made in the form of controllable contribution against investment made in the form of controllable investment. Now the major disadvantage is the residual income is normally an absolute number, which is a figure, and as a result, I'm not able to compare it with other divisions, with the group, or with other companies in the industry. Why? Because since it is an absolute figure, the factors contributing to my entity having a residual income of, for example, 1 million could be different from another entity. And also the major disadvantage is it is an accounting-based measure of profit. So this sums up the advantages and disadvantages of return on investment and residual income. Now let's discuss further into how they tie into the net present value. So net present value, again, it is not a new concept, as you have covered net present value from your previous studies. So net present value, we covered it under capital budgeting. So say I have decided to evaluate my project. So one measure I cannot base my decision based on one tool to evaluate whether I should invest in a project or not. So if, as an example, I've used return on investment and I have used net present value. Now, which project do I select? So using the net present value, I select the project with a positive NPV. So between project A and project B, they both have a positive NPV. I will now take a step further and evaluate now using the return on investment. Which project has a higher return on investment? As an example, project A has a higher return on investment. So I'll select project A. But project A's return on investment might be lower than the division's return on investment or lower than the group's return on investment. So based on that, should I invest in a project which will result in a lower divisional return on when compared, will result in a return on investment which is lower than the divisions and the group's return on investment? Likely not. So after I've evaluated the NPV, I've evaluated the residual income, the return on investment, sorry. I can now tie or make a decision now using the residual income. As we highlighted, it considers income earned relative to the investment made. I'm now evaluating. If I invest income of so much, if I invest funds of this much in the form of investment, I'm able to earn income of this much. Is it income that my shareholders are willing to accept? If the answer is yes, I then now accept project A. So that's how I would make a decision linking the net present value and the return on investment and residual income. Now the next step, after I've gone through this video lecture, go to part 2 of performance evaluation. Thank you. See you in part 2 of performance evaluation.